We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodvich. Joining me today is Peter Grandich from Peter Grandich and Company. Peter, thanks for joining me today. How are you?
Always good, Tom, to be with you. Thank you.
So I wanted to start by getting kind of your thoughts around if the markets are pricing in the risks that we're seeing right now and also the uncertainty of the election.
If you were asking me that regarding the U.S. stock market, I would say absolutely not. The complacency there until the last day or so has been just extraordinary high. If you ask me that by looking at something like the gold market, I would say, yeah, I think some people are recognizing some of the major issues that we're facing and can only get worse, not better. So it depends on which market you look at. The complacency troubles me in this sense, Tom, is that I've been around for the three other cracks. That's how I started my career in 87. I've seen it in 2000 and 2008. And I would say the issues totaling that we have are far worse than any of those three. And yet I see a lack of any real concern here with this caveat. Those issues were able to be somewhat fixed, Band-Aid, depending on how you want to look at it, because politicians were able to go in a room and make some tough decisions. Mm-hmm. I don't think that's the case anymore. I don't think our system here in the U.S., where Democrats and Republicans hate each other so much and also have a splintering from their center of groups, will allow any meaningful opportunity to fix whatever black swan or gray rhino that may come across us. So, yeah, I think it's a tale of two worlds.
Mm-hmm. Peter, when we think about the mechanisms of, helping fix a crack, as you said, does that play into this idea of, Republican versus Democrat? Of course, the Fed and the Treasury are usually the ones in charge of really fixing any of these financial cracks. So is it more a case of the Fed's ineffectiveness or inability to fix these cracks at this point? Or is it that we need Congress and the Senate to be able to pass these things?
Well, I think they're a major contributor for the problems that we have. Let's take a breather and take a step back. We had a pandemic where, if you think about it, I think it was something like $7 trillion was printed to supposedly fix that problem. And then we had a Fed that said there's no need to worry about inflation, although people were warning that such creation of money at that time would cause it. And then when it started to show, they came up with a word that I am certain has been removed in all Federal Reserve buildings and out of their book on teachings on what you can say and can't say, and that's the word transitory. We heard that for quite a while. Mm-hmm. And of course, it got out of hand, and now we've been in this, what we call so-called tighter mode by the Federal Reserve until most recently and all. They are part of the problem, and the part of the problem is that there is no more even a sniff of anybody looking to put the financial house back in order. You could at least look at certain points in time from both sides of the aisle when there were people who were actively trying to make that become a reality. I gave a talk recently, Tom, to a bunch of young financial advisors. There wasn't anyone over 40. I was certainly the old man in the room. And I asked them, when was the balanced budget last in our Congress? Some said, just before COVID. I said, no, President Clinton was the last time, and that was a massage balancing. I said, don't you have any concern when a government itself can't balance its own budget, yet you're expecting them to make sure people do the same? It's preposterous to think that we now have, and this is a man that started when there was less than $1 trillion in long-term debt, that we can accept what just go in one ear and out the other, that there's 35 trillion and have a congressional budget office, which is really the last place where there is some bipartisanship, now ratchet up again and say that we're going to $54 trillion in less than 10 years. And I asked all these young advisors, I asked all the people we sit with in our planning group, please explain to me with a simple interest at 5% on $50 trillion, how do we pay 2.5 trillion in interest expenses and still maintain the government in the manner that we've grown accustomed to? It's an impossibility. So, Tom, it's no longer way out there. It's in front of us.
Mhm.
And most people listening to this, God willing, are going to be alive when that time comes.
Well, with this exponential growth in debt, it just seems like there, as you say, there's no political will or even recognition that this is, or maybe acknowledgement is a better word. There's no acknowledgement that this is a major issue. I mean, why is it that, or why do you think it is that politicians have this ability to say that the macro economy or how countries function is different than how a household should function? Like, where do they justify these ideas?
Well, because the society in general, at least here in the US, that's all I can speak for, allows it and lives for today. See, I have a planning group, Tom, and I sit with people. And first of all, let me break this down. I think this is important. The vast majority of people don't have any formal financial planning. They don't. Most, when they do it and do it either through the help of some financial person or not, they do what's called needs-based planning. They got an issue. Oh my God, I got to save for the kids' college. Oh my God, I got to save for retirement. They go from one to the other and the other. And even if they get to that part, almost all families, including the athletes I once dealt with not too long ago,
Mhm.
all are living at least one lifestyle above where their finances support. And how do we know that? Because of the continuing increase we see in consumer debt, the continuing we see of people having less for the future because there's what they should be putting away for the future, they're spending now to live a lifestyle above themselves. And Tom, there is a poster child for this. This industry didn't do anything wrong, but it's the symbol of how bad things are. And that's the every few miles you drive on a major road, at least in the US, and you see a sign that says public storage. There are all these facilities that are holding all this stuff. Granted, some are for businesses, but a lot is people stuff they no longer fit or decide to keep in homes that are much, much bigger now than our parents and grandparents had. So it's a society of having too much, living for today, trying to keep up with the Joneses. Politicians haven't had much to worry about getting much kickback as long as some people thought whatever was happening, a little piece they were getting. And it will only come in one major wake-up call, probably, which is, as I say, and why I've gone to say that we need to build a financial ark. I only think we're a few years away to where we're going to have that problem where interest payments on US debt is going to move to the forefront, no matter what party you're at and no matter who you're listening to.
Mhm. It's funny that you bring that up, that idea of living beyond your means. I had a discussion with a friend last week about how we were both living far below our means and, actually saving and trying to put away for tomorrow. Do you where do you think that change came from in our society, Peter, of just consuming for, as you said, today?
It started with that big box that came out when I was an infant called TV, and it really got expanded through that thing called the internet.
Mhm.
And the way people see and are exposed and marketed to, and more stuff equals more happiness. I'm convinced that both Madison Avenue and Wall Street conspire knowingly or unknowingly to say that basically the guy that's always more happy is the guy that owns the bus company versus the guy that drives the bus. And therefore, you got to strive to own your own bus company. And by the way, we can help you do that. When in fact, in real life, some of the happiest people I've ever met are people with little or no means.
Mhm.
And some of the wealthiest people I ever dealt with, including the athletes that were making tens of millions of dollars a year, were some of the most unhappy people down deep and all. But this convincing that more money equals more happiness has been the carrot and the keeping up with the Joneses and all. And it's not just restricted to the US or Canada. It's true much of the Western world. It's one of the reasons why the people who strive to get here, because they see a lifestyle that's just unbelievable. If like you, I know you travel. If people would ever go to some places, I remember looking at gold mines in Africa and all, and saw how the average person was living there, we'd be thrilled. That's why so much of this immigration, and I don't hold it against everybody, I certainly can understand if you could leave a place like Venezuela or a South America country and get to the US, even though we may not think it's up to standard, what we're giving them right now is a lifestyle that's only a dream from where they came from. And that's the problem. We have too much stuff, Tom. We got too used to having too much stuff. And one of the problems is we've had a government that's always willing to take from the future to give what looks like enough to enjoy now without the ramifications that are now coming before us.
Peter, going back to the stock market, what do you think are the most analogous times in history to what we're facing right now? You know, we have this extreme concentration in only a few stocks, and outside the top handful, the rest of the S&P, for example, is essentially flat to down for the year. So, you know, are there other examples in history where you've seen this?
I understand why people could start preparing to the depression and that stuff, but let me tell you what's dramatically different about the stock market, Tom, and I don't think a lot of people take this into account. I think it's critical. When I entered the business in the early 1980s, almost 90% of the trading on the New York Stock Exchange was retail, was investors. And they were acting what a stock market was originally set up to be, a place where you can buy and sell part ownerships of businesses. That was, well, since that time, it's done 180 degrees. Now, the vast majority of trading is institutional, but over half the money now that's in equities through various ways are in what they called non-active accounts, accounts that are not looking to buy and sell each day. They're trying to trace and follow an index or a type of group or a performance. And then the remaining half, about 80% of that, is being traded through some type of computer-driven program, some algorithms, where maybe simply just based on news events and words that are in news stories, to very sophisticated programs and all. And that group that used to exist that went into the market to buy part ownerships of businesses, they're the smallest part of it now. So it's probably not the best idea to look in the backwards and see what this is similar like. I'll tell you what, there is a commonality. When you read about the roaring 20s, and when we got to the late 20s, within a year or so of the great market crash in 1929, there was this way living beyond the means. People were super extended. They were borrowed. They couldn't support their own selves. And it was just total, it can't miss. In fact, Irving Fisher made that famous comment, the stock market is at a permanent high plateau. That's pretty well, if you listen to a lot of the talking heads that you'll turn on networks who work on Wall Street, are basically saying to their clients as well. And how we know that is we saw that in the VIX recently. Despite all the things that are happening, despite, the political things that have just happened in the last few weeks, we still see a level of complacency and little or no fear in people. And that's when those type of black swans, gray diamonds, they hit. That's where they come from. And that's why, to me, it's not a question of if, it's just a question of when.
So, Peter, when we think about, the mechanics, as we were kind of talking earlier about the Fed, what the Fed has for its tools available to save a market crash, do you think it still has the ability to come in and really save investors from a scenario where we see a dramatic drawdown?
Always good question, so it deserves a very good answer. The perception is that the Fed can do that. The reality is they're not in the same position that they've been in the past to do those things. And what I mean by this is we went and interviewed any 100 financial advisors now in any part of the United States and basically asked that question, are you comfortable with the Federal Reserve being able to step in if there is a bad event? Absolutely, they would tell you. They always do, it always works, and it's always the Fed put, which it's commonly known as. The problem that it has now is it doesn't have the ability to go and take trillions of dollars. Could you imagine if for whatever reason we had to inject and create another $5 or $10 trillion for some type of issue? Do you imagine what people would say about what it would tip the scales of minority indebtedness to the point where real concerns would overflow about the United States abilities and tied it into all the other issues? I think the surprise to the people when we look back a couple of years from now will be is the Fed was unable to act as it has in the past, and they know it. It's one of the reasons why, Tommy, they've tried to stay more neutral to tight than they normally would be at this point in time, because they really realize that. I mean, if I was the Federal Reserve, I bet you if we can sit with them secretly, there'd be nothing more they would like than a 10 to 20% decline in the stock market orderly over a year or two, and just see a more of an economic malaise. That they don't want to see a deep recession, but that would be their best case. The problem that they have with that is their tools have been taken away from them because we become so more dependent on outside forces. And that's the untold story. And I'm kind of leapfrogging, and I'm sorry for doing this, but the big thing that I think Wall Street is missing, Tom, is how the change in the world authorities are happening. The BRICS, and we'll certainly know if I'm right by this fall when they meet again, are becoming such an overriding influence on what's going to happen here and around the world. And we're not in a position and don't really have any cards to play because we're that kid that they're all saying has to stay outside and can't come in and play with us other kids. And so I don't think the net to your answer is that the Federal Reserve is in any position as it once was to do as much that will be needed when we get this day of reckoning, which to me is only a matter of months to a couple of years at most away.
Mm-hmm. Peter, something I've been thinking about a reasonable amount lately is this idea that, the dot plots and the markets are kind of showing that they think that the Fed is going to be cutting sooner than later, like by the end of the year here. But even if they get, I think one of the highest projections was 8 25 basis point cuts, that would bring us down to 3.25% to 3.5%. That's a lot higher than we were, before COVID, let's say. So does that in some ways satisfy both of these ideas of, on one hand, being higher for longer, because we didn't say higher compared to what, while still easing market and financial conditions to the point that we can kind of tiptoe around this, as you said, recession or dramatic crash?
Well, I believe that's what the don't worry, be happy crowd on Wall Street is counting on. But what I don't think they're prepared for, and again, like I said, in a few months' time, we're going to know it. What hasn't been spoken about, I shouldn't say that, in mediums like yours and where I speak, there are people talking about it, but in mainstream financial world, no one's talking about how much foreigners are divesting themselves from American securities. We just continue to see more statistics out today on how foreigners are selling so much more foreign American assets, especially bonds. And what could transpire in that scenario that you painted, the Fed may want to cut interest rates, but it may not be able to because there suddenly won't be any real interest to do the continuing financings of these this is still hard to say, Tom, multi-trillion-dollar yearly deficits that we're running at. And that's what the shock can be. And I think they know that. That's why I think they've been more hesitant than normal to start cutting rates, because they'd be really concerned that would lead to the dollar declining more sharply and add to an already serious problem they know that's happening behind the curtains, most of the curtains for people looking, and that is the continuing moving away from American debt from foreigners.
So, Peter, as we think about, destabilizing forces that could affect the markets in the world right now, where do you see the biggest risks lying? Is it from conflict overseas, domestically, or, is there something else that you're concerned about or watching closely?
So back in March, I decided to tell our clients it's time to build a financial ark. because socially, politically, and economically, America entered this worst scenario. Let's start with this. This is probably really important as you and I speak, Tom. Imagine you and I, and you're old enough to 10, 20 years ago, we're sitting somewhere talking about the following. And I say to you, hey, did you hear about that country, the former president who's trying to run again? Since he's tried running again, first they impeached him twice when he was the president. Then they tried to claim that he led a revolution. Then they brought all sorts of charges, 36 or 7 different charges. A few he was actually found guilty. We don't know what's going to happen. And he may have recently been attempted to be assassinated. And the other guy that's currently there now, who seemed to have sided with this group that went against this other guy, which we just explained, he and his family seem to be not the best of people, have a lot of issues. And now he's gotten to the point where the group that was just backing him a few months ago wants him out. This is what you and I would have said. What third world country are you talking about, Pete? Are they in South America, Asia, Africa? No, it's the United States. That's part of the complacency. And you can only have to be around, as you and I have been around, to appreciate how laxed we've been just on this political impact that's happening, not counting the social and economic ramifications from that. So I think that's probably a thing that's going to become more apparent as we get closer to this election on how that goes, the political fallout from that. Listen, I don't bang war drums or anything like that, but let's just say there is one or more adversaries out there that would like to move against the United States or at all. Well, who would you rather move against? What looks like potentially will be the replacement for Biden, who's clearly wounded, even if he makes it to the end of his term. His replacement, which right now people would estimate is the vice president, or Trump. I would say the adversaries, Trump would be their last choice. I do believe that he has a track record that they could say to themselves, he could be a formidable foe. So anything we need to do now, we need to do it in this window, because it looks like come January 20th, he's going to be back in charge. So one of the potential surprises now is a movement by one or more adversaries that might have been accelerated because of what's happening here politically. Now, a lot of people would watch this, and especially from the Don't Worry, Be Happy crowd. Granted, she's a nut job. It's probably, what does he sell? Gold? No, I don't sell gold. I believe you should own it and all. But that's just one. I can spend the next half hour giving you other scenarios related to that. But it falls back to what we just discussed. The complacency giving the valuations that are being placed on the market in particular is way too high. The risks that are out there demands much better pricing if I'm going to take that risk. That's why I said to people, I sooner would invest outside the United States than in the United States. I was a big component at the end of June that get out of technology. If you're going to be in the US, own small caps, or at least look for some type of product that gives you downside protection. Here in the US, that's an equity index annuity. Yes, they take part of your gains if there are certain amounts, but they also lessen or eliminate your losses. Here's the big picture line that I use, Tom, in our planning. We now have to go for capital preservation over capital appreciation. Doesn't mean you stop trying to make money, but the first thing you need to put in order and all is that you have a good hold on preserving what you already have. Then, and only then, you can then say whatever is left to put at risk to try to make more of something.
Absolutely, Peter. One of the other, I guess, not necessarily risks, but factors that I think we need to consider here is the rise of the BRICS nations and how you understand that alliance to be growing and or shaping the world. What is that agreement as you understand it, and what does that mean for gold investors?
Very good. I'll make sure I answered the second part as well, because I'll get too caught up in the first one. I've been a huge proponent to how big the BRICS are going to be. I've said for 2 years now that when it's all said and done, somewhere within the next 3 to 5 years total, what they will do to world trade and the impact will be the same what the Industrial Revolution did to world trade. So that's a big, tall order. I've also stated that the America will be outside looking in. This is not something that we're going to somehow partake in or make something offer. Remember, these are groups of nations, for whatever reasons, there's not enough time to discuss why they should do this, and they're smart to be doing it. But they're looking to trade away from the United States among themselves and out of the U.S. hands of potentially a monetary and fiscal system.
Mhm.
So if they're going to do that, they have to create something on their own, which has already been underway, and discussed a lot of this in my own work and some of the other people that I interview. But one of the big things was, and one of the biggest reasons why I've been so bullish on gold was, my argument was gold had to be a part of such a thing. At the end of the day, there needs to be something more than just a fiat currency for what's going to take place in the next realm of whatever happens world economics. And therefore, that's the big reason why so many of those players that are more and more making up what's turning out to be the BRICS have been big buyers of gold. And an untold story that is discussed a lot, and I'm not the first to say this, a man named Andy Schectman has brought it up a lot, is how much different countries have repatriated their gold from the United States.
Mhm.
It's a topic that hasn't got. Why on earth are these countries taking all their gold back that they had the U.S. hold, while many of them are also aggressively, their central banks, buying gold? Tommy, it's not for a trade. It's not for speculation. It's for what many believe, and we're going to learn, I believe, a good hint of it come these next fall meetings by the BRICS. And that, I think, is going to be the next elevation for the gold recognition, and for even the don't worry, be happy crowd to finally wake up and go, wait a minute, we better start picking and start learning about this, because that's the way of the world. That's where we're heading.
So the second part, what does that end up meaning for gold investors, Peter?
Well, I never thought I'd say this, because remember, I've been an advocate of gold from 1200 and above, saying that 2536, which seemed awfully far away when it was 13 or 1400, not very far away anymore. And I would have said to you as late as a month or two ago, hey, Tom, we really shouldn't get too excited about a price much above that. I was never in that camp but I think we're going to have to start thinking of a much higher gold price. To me, it seems that if I'm correct in what we just discussed, and the recognition that gold is going to be used again in a good part of the world by a good amount of the players, then suddenly people are going to beat a path to it. And I think it's you that have said it recently, that the standard ownership of gold in the country used to be about 2% in portfolios in America. Now it's half of 1%.
Mhm.
Oh, that means there's a 300% increase if it gets back to historical. I certainly think if I'm right about the picture I just painted, then you can make an argument we can go back to that type of percentage ownership, which would mean a much higher price than it currently is now.
Mhm. Peter, you speak about building a financial ark. What are the main pillars or components of that?
Well, the biggest part is that become more dependent on yourself than government. Because I believe, look at it this way, Tom. Let's just say the Congressional Budget Office, who hasn't been wrong in their predictions for over 10 years, they've seen all these rises. It just gets to 50 trillion in 10 years. And interest rates are just 5%. That's not a big historical rate. That's $2.5 trillion in an interest expense, hard interest expense, not something you can just write off and say, oh, I'll pay you next year.
Mhm.
2 years ago, we had our best year as a government, $5.3 trillion. So we give some raise in government revenues, and it gets to $6 trillion by then. We'd be looking at almost half of all our income going to pay interest expense. What's left cannot run the country as it runs today. So, that's at least a government that still theoretically can print money. What about states and local governments who have to balance their budgets? What condition? They're going to get even less support from Washington.
Mhm.
So, depending on government assistance, should be something you should be moving completely away from, if not aggressively away from. Be self-sustaining or as far away from government having to be there for you. Also, you need to have a reserve. 65% of Americans are working paycheck to paycheck, Tom. They have no room to put away discretionary funds for a rainy day, or worse yet, retirement. Yet as they get older, it become more difficult to keep working. And what will transpire? They will naturally do what any human will do, is look for government to help them. And in every instance, less is more. If you ask me for one description to mantle over Peter Grandich and Peter Grandich, our planning group, is less is more. And that's very, Tom, I know you are this way. I know I'm singing to the choir in this particular case, but we're the real exception to the rule, Tom. That is not how Canadians and Americans are living at the moment. And that's very hard to once people become and believe something is their right, it's hard to take it away.
Mm-hmm.
And we've had governments that have catered to a select group of people who have gotten very spoiled, and it's going to be very difficult. Just as people say, oh, you know, the immigration, put up a wall or send them home. How do you send? We have 10 to 20 million illegal aliens in America. It's a nice feeling to say, oh, send them home or stop them showing up. But how do you actually do that?
Mm-hmm.
And are they just going to say, okay, I'll be willing to go? There's the complacency and lack of preparedness for anything other than a sunny 80 degrees day. I joke when I say I built an ark. Noah must have been a sunny 80-degree day, had people going, jerk, what are you building that big ark for? It's sunny. Oh, it's going to rain. People would go. It's the same thing now, Tom, right? 8 out of 10 people that hear what I have to say scoff, and even if they become interested, they then go down the street to the, our so-called competitors, and they paint a much, much rosier, palatable position, and that's what they go with.
Mm-hmm. Peter, something I would like to ask you about more so as a concept, is if you look at really trying to invest by seeing bubbles, let's say. So if we kind of look at this financial landscape or all of the things that we're able to invest in, do you look at or do you try to define bubbles and stay away from those? And how would you define bubble?
Bubble is, I think, when a lot of times you can see it technically, it's more in a parabolic move where instead everything should kind of go like that, but instead it's almost a straight vertical movement. They tend to go further than you could ever imagine. That's a hard lesson learned in 40 years. Mm-hmm. Tend to take longer. And the further they do go, the harder and quicker they will fall when they break. Contrarian investing is a little bit more difficult now than it was 30, 40 years ago, because I talked to you about all the computer trading. And, we got vast monies that are trading in markets as you and I speak. They don't care about what the CEO's name is. They don't even know the name of the company. They don't even care what the company does. It's just a vehicle. It's a arithmetic statistic. It's just a numbers game. But the reality is still how individuals look at markets is that part ownership of businesses, yada, yada, yada. It is only going to be far more challenging for an individual investor who I view has at best pea shooters, and these other groups that you see basically have ballistic missiles. It's good that you read about David and Goliath in the story that some kid was able to throw a rock and knock down a giant. But in the real world, the pea shooters are going to get crushed. And that's the other problem I see right now, Tom. I'm seeing more people now in these last couple of months that come in for planning who are, I'm trading on my own. And what is their portfolio full of? All the household names have been going, through the roofs. And that's another signal of when you're in the midst of a bubble. Will some of them get lucky and sell before collapse? Absolutely, but most won't. And then the unfortunate enough of is they get hurt so bad that when it does come time when there's something appropriate for them to be in, the thing Wall Street doesn't manage well at all. Some people that work in the financial service business are very good to their people about financial risk, even if it means them not making a commission. There are people like that. But what most people on Wall Street can't measure and understand and appreciate to the level I've learned to do, because I've done it to myself not once but twice, and that's lose a lot of money. Mm-hmm. So mental anguish. And what I'll tell you right now is if and when this turn or decline or sell-off that you and I believe obviously is coming, the mental fortitude to live through it is so slim now compared to like it might have been before. Mm-hmm. It's going to accelerate more to the downside. And all these people that come to you, yeah, but the program shows if you buy and you hold and you stick with it, it always turns, always looks good on paper. Mm-hmm. The moment they got to live it in real life, they will bail, most of them. Mm-hmm.
So with this framework of how you understand bubbles, Peter, what if any anti-bubbles or something that is in an inverse bubble right now? Are there any sectors that you have identified that you, just from an anti-bubble perspective, that you find attractive?
The only market, and Tom, in the last few days, I went to perhaps the largest holdings ever in this arena. But I want to caution, what's good for me many times isn't good for a lot of other people listening. But the only sector that I can find where it's complete undervaluation across the board is in the junior resource market for companies that look for metals and base metals, given where the underlying commodity that they're hoping to find. And I must put an asterisk, that industry is a business where failure is the norm. 7 to 8 out of 10 will not find, discover, bring to market, or sell for worthwhile money, whatever the commodity or commodities they're looking for. But as a whole, given what the underlying commodity that they're looking for sells for, that's truly where I can only find across the board undervaluation. I do think there's one sector that if I was younger, Tom, I would spend more time looking at. One thing is for certain, the need for general electrical power is acute. That's why nuclear energy always plays a role. But now here in America, we've had some meetings that didn't get a lot of coverage because of all the other stuff that's happening politically. But it's scary to listen to some of the hearings recently about the inability to provide day-to-day power now across the board in most places in the United States. The grids, the antiquated systems, the real thin line now of where people may start to, where in other countries they get used to not having powers at certain parts of the day, et cetera, et cetera. Eventually, money and big money will have to be put to that, because if you're going to have AI, if you're going to have crypto mining, or all the other things that are taking up huge electrical needs, we're going to need equipment and the things that go with that to deliver that stuff. And I would probably start focusing on companies that are going to benefit from those type of products. But at my stage in life, and plus I have a lot of experience in the background dealing in mining, I don't have any in power, but I do think that's another area that is probably something that money could be made in.
Interesting. Peter, I think part of that equation is something you and I have talked about before, and that's uranium. So is that market kind of taking a breath and consolidating now, or do you think it's time to kind of exit that market?
Well, I exited in January, but let me tell you why. It's not because I thought it was the end of that bull run. I got blessed to be in so early. So all our gains were anywhere from 100% to 500%. And Tom, I spent too many years watching 100%, 500% gains turn into losses. Mm-hmm. I wasn't about to do that again. That was my main reason to exit. The other was that uranium got above 100. It was near almost 110. And there were all sorts of predictions of 200, 300. The difficulty that still exists for uranium is this, in my opinion. Unlike any other metal, there are so few real producers. There's only three ways you can invest in it. You can invest in the people that physically own it, and there are now ways to do that. You can invest in people that develop it and sell it. There's a handful of them, but then the rest of the market are people just trying to find it, develop it, bring it to market, etc. And my feeling is for most people, you need to stick with just either the ones that own it or find it, produce it, and sell it. That's speculative end because of now I'm in this capital preservation. So the only way I see myself re-entering it is if there's a substantial further pullback than it's already happening now, or suddenly it becomes even more evident that we need even more power than we even thought of. It's probably going to be the former, not the latter. So it's probably going to be relative price for me to look to be involved in it again. But I would not be against anybody if they sat with me and showed me that they own the producers, the chemicals and others. They own the sprots of uraniums that own the physical uranium. I see no reason to have to bail on that there's some big 50% loss coming for them and all. I just think all that high expectations that existed earlier this year, where, rocket ships every time on the internet, uranium was going up and a lot of people were posting that. I think that got ahead of itself. So, but to be fair to you also is I would certainly own uranium stocks before I'd own any technology stock.
Mm-hmm. Peter, another piece of that power issue, I think, and especially in this greenification of our economies, is the base metals. So do you look at this simply from a supply versus demand picture, and also this kind of cyclical underinvestment picture that these mines and exploration companies have suffered? Is that the base case for why these are also attractive to you?
It is. So there's an argument. Let's take copper right now. On one hand, copper has an extremely bullish outlook if you get past 2024. Mm-hmm. So if you're investing for amount of years, not days, weeks, or months, copper has an outstanding argument. But copper also falls back at times to what it really is, and that's sensitive to economic needs. And right now, the changing puzzle that if you and I don't know when we last spoke, but 6 months ago, we wouldn't have had this discussion, but now we need to mention it. And that is suddenly there are really concerns about the strength or lack of the strength of the Chinese economy. And it's not just hearsay, there's a lot of concerns coming out. And when one of the biggest users of a particular metal, which they have been for copper, starts having some concerns on top of a U.S. economy that's clearly has slowed down. I think it's been even stronger slowdown than the government statistics want to support. That kind of puts a damper on a sharp rise for now on copper, but longer term, and you get to a more important picture that needs to be discussed. We probably have had at least a decade or more, Tom, of very little new capital going in to find major mines around the world for a couple of reasons. One, you can no longer just spin a globe, land on a country or a point and go, yeah, we can go mine there. A lot more concerns for mining companies, political, economic, social, or what have you. Second, some of the best mines have basically come and gone. That's why we're watching the average grade in copper declining. So companies have to move more ore just to get the same amount of copper. So it's more expensive. I can't imagine any major copper company that will have to spend $1 billion or more is going to do that unless they're certain that copper is going to be at least $4, if not closer to $5 or more. That's why when we started to get to 5, we saw a big run up in the copper stocks, and now they pull back as we move back towards 4. I don't think we're going to go much under 4 in the worst case scenario, but I do think copper is more sensitive to economic factors than gold or silver. Now, silver kind of falls in the middle. Still has a weight of being a base metal in a sense in terms of industrial use, but it does get some favoritism towards being a precious metal. and gold is just a precious metal. And Tom, what we didn't talk about, and I should have kept quiet because I know if we do, it's only going to cause me hated emails. But one of the big things that has stolen the lunch of the metals, particularly the mining shares and the juniors, is the movement towards cryptocurrencies. I'll simply say is I'm not a fan of them. I don't think they do or will end up doing what the highest, biggest promoters claim they will. But up until this interview, there's no taking away that they have taken away a lot of the capital that would have otherwise flowed into metals, and particularly on the smaller scale junior exploration companies. And so if you are a big believer in the junior exploration companies, it's not in your best interest to see things like Bitcoin keep going up and up, which it hasn't. It's been stuck in a trading range. And quite honestly, to see somewhat of a turn down in them along with the stock market, with this caveat, you don't want either one to crash because it wouldn't give time for rollout. Money would just disappear.
Mhm.
But I do think, again, the safest of all is gold, and then some of the base metals. I think one air that's been let out now is lithium. I think the EV argument at best has lost half of its argument. I don't think, especially with Trump and what he's saying and how he's basically not at all for that electrification that this current administration got all over, including yours up in Canada. So the EV part of the greening will probably be tempered a lot, but we still see some makeup in that on what people still believe AI is going to. But even there, we'll eventually see some sort of dampening or lessening of expectation as well.
Mhm. Well, Peter, I don't think it's overly controversial to say that there's a lot of capital that would have otherwise flowed to this sector that has gone to cryptos, and even to the handful of stocks like Nvidia, Amazon. There's all number of outlets for that amount of capital, and I don't think gold is completely immune to a crash scenario either. But I think, very likely it's probably going to be that recognition of one of the safest plays once that bounce back comes that really holds a lot of promise for people, right?
I think one of the things, I don't want to run out of time on you, Tom, and I'm grateful for whatever time you always give me, but the only real crash scenario we've had was 87. 2000 and 2008 weren't real crashes. I mean, when the market, I was alive. That was the thing that claimed the fame. I made this forecast. I'm this young kid. I'm in the business less than 3 years. I'm head of investment strategy for a New York Stock Exchange member firm. I forecast a crash. They laugh. They want me to resign. 6 weeks later, it crashes. And the next day I say it's going to go back to a new high in 2 years.
Mhm.
But that was a crash. That was just overnight, a lot of money lost. Part of the reason that happened was because there weren't some of the safety valves they built into the market. The market just sold on itself and there was no cooling off period. It's probably what helped save the other two markets that had big downturns because they have these mechanisms. The only way I see those mechanisms getting overcome is something happens so diametral outside the market that it doesn't matter what kind of mechanisms you have. So I'm not worried about a crash, but I do think markets will roll over. And when they roll over, they're only going to be beneficial for gold. Gold, I cannot come up, and that may be a reason for you to sell, Tom. I cannot come up with a bearish scenario for gold going forward.
Yeah, it just seems like, again, there's just so many tailwinds in this direction that if you have some patience, you're going to be rewarded for. And instead of chasing the shiny, promise of something like Nvidia, where it's very likely going to end up falling a lot quicker than you can imagine. It's going to be a scenario where I think a lot of people are going to get hurt.
I'll close with this, Tom. I tell all our clients when we sit down now, if they're willing to hear from me, there's only 3 tier 1 products in the world:
Mhm.
stocks, bonds, and gold. And any good counseling should be that you should have some interest in the three best, what's viewed as the three best investments in the world. And 98 or 99 out of 100 new potential clients that come in to see us have little or no ownership of gold at all.
Mhm.
And so that's another reason why I feel we're not anywhere close to the top. It's because when it changes and a lot of people coming in and they know about this great new gold company in some third world country and they're touting it to me, then we'll probably be closer to gold's top, but we're not anywhere near it in my book.
Mhm. Absolutely. Of course, for anybody that wants to hear more from Peter, all of your stuff is available at petergrandich.com and, of course, on Twitter at Peter Grandich. Peter, thanks so much for your time today. Really appreciate it.
Thank you, Tom. God bless and keep up the great work.
Thank you, sir.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.